Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and I'm joined here again by my advanced planning colleagues, Keely Jo French. Hello. And Jacob Messick.
Troy, how you doing today?
I'm doing good. So what are we going to talk about today? Today, we're going to initiate a 3-episode business owner focused arc, if you will. And in that arc, we're going to focus on business owners and focus on the problems and ideas that business owners will think about, will keep them up at night, pain points, a lot of the things that we've talked about in the past, but we're going to dive in specifically across the 3-episode arc. Today, we're going to focus on sort of the tried and true. Focus on any business owner. In fact, not even a business owner. You focus on, an individual and the idea of taxes and how it affects and planning for and minimizing taxes and all the conversation and the machinations that people will go through to minimize tax. And we're going to focus again on the business owner and how that plays into those early discussions. Oftentimes when it's about setup, what should I be? How should I, what type of business entity should I be? What are the tax benefits and what things, should I be thinking about? Sometimes that separates short-term versus long-term thinking. We're going to dive into that a little bit today as we kick off our 3-episode business owner arc. How's that sound?
Sounds good.
So in the intro, we talked about structure and we talked about a little bit about taxes and that decision that oftentimes is tax driven when we talk about what type of business am I going to be. And when I say type, I don't mean am I going to be a manufacturer or if I'm going to be a dry cleaner or plumber or whatever, like what type of business entity. And usually that decision is around simplicity. And it's around taxes and minimizing taxes. And that's what we're going to focus on today. So I'm going to ask you guys a question, and I know it's a loaded question. So I want to see you guys fight a little bit, okay? Argue a little bit.
You're going down.
This side of the table doesn't fight. We go with the flow.
Really?
Really?
Do I need to acquaint you with previous Future Focus episodes?
No, I think.
All right. So here's the question. Should a pass-through business owner...
Pause.
What?
What's a pass-through?
No. I'm asking you the question. No.
He said pass-through.
I'm asking you the question.
I mean, he's still...
Someone needs to define it, right?
He's still asking the question.
He is,
here's what we need to do then. We need to define pass-through, and I'll give you that idea. I'll give you that in your description of it.
So is jumping to like the Uno, does that cause someone to have to put one in there?
Hey, yeah.
Jump too
You guys
quick?
do it to me all the time.
That definition better be stellar. All right. So should a pass-through business owner own permanent life insurance inside their business, or should they own it personally? And that's a question that we get. So, we're sort of jumping ahead a little bit, but that's a question that we get a lot. Like, what should we do if I'm a business owner and I'm thinking about my business and for whatever reason, risk mitigations, some of the other things that we talk about, life insurance with a business owner being used, we get this question a lot. So what should they do?
Yeah.
And I should say, before we get started, like always, this is purely educational. We're not making a specific recommendation. The idea is to have a discussion and to sort of educate, not make a specific recommendation. All right.
Oh.
Okay. So now, pass through and owning life insurance. Should they own it personally or should they own it inside the business? React.
So I think before the life insurance question is probably what Keely Jo was saying. What's a pass through? And we know Keely Jo is the accountant background in the room, so I'll take a stab at answering the question. Keely Jo, you can give me a thumbs up, thumbs down. If I do a bad job and a thumbs down on the description, I'll throw a pebble.
I was about to say, that's a fee.
All right, so pass through. I'm going to try and say this without having to throw something in. So pass through entity, that is a business that does not pay federal income tax at the corporate level. Instead, any income from the business passes through to the owners, who then pay federal income tax on a individual personal level on their individual income tax returns each year.
Correct.
Good?
Good.
All right. Anything else to add?
No.
No? What?
I'm just kidding. I'm just kidding. I just want you to put one in the jar.
There's obviously a lot more to it, but just very simply described, that's what it means to be a pass-through company, whether it's a sole proprietorship, a partnership, S corp, an LLC tax as a partnership, all of those,
What's an LLC?
What's an LLC tax as a partnership?
Limited liability company tax as a partnership.
Pay in.
No.
Pay in.
Yes.
All right.
You brought it up.
All right.
You were home free.
Yeah.
You don't want to start throwing out. You had to say S corp and LLC, didn't you?
All right. Well, but yeah. So.
Yeah. So they're all. So just, I mean, we're obviously joking, but LLC is limited liability company. S corp is from subchapter S. So S corporation is what it stands for.
Subchapter S.
Hey, so that's the name. I'm not defining it.
I'm good with that.
Exactly.
I'm good with that.
Anyway. So it's S corp. It's your general partnership. It's LLC can be taxed as, like the aforementioned S corp, can be taxed as a partnership. Those are all forms of pass through entities is what we're talking about. All right. So that was the first part of the question. Now get to the second part.
Yeah. So I think the second part, should the business own the life insurance or the individual own it personally? I think it really comes down to one thing. And really, when we get these type of questions, we try to break it into three parts, three key parts. And Troy, I feel in a gaming mood. Shall we play a game? If you can name those three parts of usually how we have these conversations, I'll throw a pebble in.
If I can name the three parts. What about Keely Joe?
I have no idea what he's talking about.
I'll put you on the spot.
Okay, so three parts that we normally break these into. First of all, it's what's the client trying to achieve? So what is that one?
You're getting close. Yeah, you're on the right track.
So what does the client want to do? What's important to the client? Okay. What's most important to the client? No?
Okay. No, it's even more simple than that.
Okay, three parts. I want to kick myself.
I think this question only has two parts.
I think I think the buzzer went off. So it's so my pebble stays safely outside the jar. A lot of times it's client concern solution.
And he was on the right track.
Oh, but no, we use just those three simple words.
He said, "What's the client's goals? Client's
concern solution." So we know the client is a business owner.
I would give you that. He was just being
stingy. He set me up on that one. But go ahead.
We're saying the solution is part of it is, should I own the policy by my business or by individually personally? But it really goes back to what the concern is. What is that concern? What is the goal that we're trying to achieve with this life insurance policy? The goal is key person coverage, which is benefiting the business in the event something happens to that key person, death benefit comes back to the business to help with that key person coverage. Is it buy-sell planning for the business? So if it's key person, if it's buy-sell, maybe it makes sense to have the business own the policy. If it's from a personal level, if the concerns are income replacement, estate planning, other retirement, or financial planning objectives and goals, maybe it's beneficial for the individual to own it personally. So I think it really comes down to what's that primary goal? What's the focus? What are they trying to accomplish with that life insurance policy? As we know, we talk about permanent life insurance. Permanent life insurance has a cash value component as well too. So I think in addition to what's the purpose of the policy and what's the purpose of the death benefit, I think there's also that, if it's a permanent life insurance policy, there's cash value inside the life policy. Who do you want to have access and control to that cash value of the life insurance? Do they want to keep that cash value of the life insurance policy inside the business for business purposes, or is the individual wanting to have it outside the business to grow an asset outside that company we'll kind of, in addition to retirement planning, like to diversify, and not just have everything all inside of his business.
I mean, you bring up a point. One of the things that you have to focus in, not have to, but we find ourselves focusing on more often than not, we find business owners who, and maybe I've said, I know I say this in our regular lives, but I don't know if I've ever said it on the podcast, where business owners get into this cycle where they work their business, they grow their business, they invest back into their business, and they get into this to the circular cycle: work, grow, invest, work, grow, invest. I'm going to work my business, I'm going to grow my business, and then I'm going to invest back in my business. And that's kind of the capitalist way, like that's the capitalist cycle. But then you get to a point where we're tapping him on the shoulder and going, hey, I know this business is great and it's going to occupy a large part of your net worth and your legacy and all the things that we know businesses do. We're tapping him on the shoulder and going, hey, maybe it would be helpful if you lived sort of if you thought about living, if only for a portion, independent of your business. That helps make you stronger and your business more valuable. Has a whole host of things that makes it worth living, or trying to live at least for a portion independent of your business. But it's hard to get out of that cycle once you get into it and you have a successful business. And that's where sort of this conversation comes into play.
Yeah. So I think there's benefits and considerations of both approaches, which is why you said, hey, this isn't advice. This is just some general information, because each person's situation is a little bit different. Maybe they need the coverage inside the business for business planning needs. Maybe they want it outside the business to help grow that asset outside their business. It really goes down to what's the objective that they're trying to solve. What's that concern what's the concern keeping them up at night? And then that takes us down the path of here's the solution to maybe take a look at.
Okay. So let's continue that on, because that conversation that we just had about where does the insurance live and all the other stuff, or should you own it personally, should it own inside the business? That's usually a discussion that should be, you should be thinking about that, or we should be posing that to the business owner upon creation, but we know that that's not the case, right? So once you decide where something lives, and we're going to try to encourage people to think about these things as they become new business owners. So once you decide where, in this case, the insurance is going to live, but either inside the business or personally, the next question is okay, so how do I use this tool to my advantage? In other words, how do I get money out? And how should I be thinking about it? So I want you to react to this question. And again, this is loaded, and I know we have we have accounting person here, right? So how do business owners generally think about getting retained earnings out of their pass-through business?
Retained earnings out of a pass-through?
Go ahead, react. And by the way, I wrote it that way because I knew she was going to react that way.
Pass-throughs don't really have retained earnings. I mean, retained earnings are usually in like a C Corp because it's taxed at the corporate level and then it's retained for the actual shareholders before it comes out and it's taxed again at the dividend level. Whereas pass-throughs, there is no corporate tax level. It's just the S Corp it's just the S Corp passes it through down to the individual. So the individual gets taxed immediately. So instead of retained earnings, we have capital accounts, but I won't get into that because it's not super important.
Because you don't have enough stones if you start talking capital accounts.
Yeah, no, you guys do not want to know about basis or capital accounts. But essentially, when you have a pass-through corporation, all the earnings are passed through to you. So if you wanted to get money out of the company, well, I guess I am going to have to talk about basis, aren't I? Can I define it first?
Yeah, sure, go ahead.
It's part of the same sentence. I will allow.
I will allow it. So with S corporations, everything passes through to the company or individual, and the individual has to pay income tax on it. Well, that doesn't mean the individual's actually getting money out of the company. The company can be retained in the company. So it's not retained earnings.
I agree. I agree. It's not
it's
retained
a very
earnings.
technical term.
Retain capital, retain basis. Just assets. Is still inside the company, but it's already been taxed.
Yeah.
I just wanted her to explain retained earnings.
No, I refuse. So It goes into what's called a basis in your capital account, which is just money that you have that you've already been taxed on. It can stay in the company, but if you want to get money out of the company, you can do it in one of two ways. You can take a W-2, which is just you actually having an income as an employee, or you can take a K-1 distribution, which is just you getting a distribution from the company. But because you've already paid tax on the funds that are in your capital account, which is your retained earnings, you can withdraw that money tax-free, essentially. Pause. This is Keely Joe. Well, the future Keely Joe. Just want to make a clarification here. I know I keep saying that the capital account is tax-free, but I meant the capital account is only tax-free to the extent of your basis. Anything in excess of your basis is taxed at capital gains rates. That's all. Back to the show. So it's really just a matter of, are we going to take a W-2 or are we going to take a K-1?
Mm-hmm.
Or are you going to pull some of your bases out?
The K-1. Yeah. So it's just, do you want to take a W-2 or a K-1? And there's trade-offs that come with that. Like, for example, with the W-2, there's a lot of additional tax, like your tax at the employee level, which means you have to pay FICA taxes, which are your Medicare, and Social Security taxes.
She caught it. She caught it.
They're the extra tax that you have on earnings. But a K-1 distribution doesn't have the same tax on it because you've already paid it. So it's not an income. It's just flowed through. There's no FICA taxes on it.
So I'm gonna take a look. I'm actually gonna take the detour this time. Like I'm in the middle of I'll just use I'll say this, my son. He's in the middle of striking out, entrepreneur, and all these other things. And one of the things I had him do was sit down with an accountant, right? Sit down, hey, because I think you want to understand the tax system, like actually have to do your own taxes, or at least talk to someone about your own taxes. And we finally started talking about payroll taxes and sort of what they mean, and hey, this is Medicare, this is this is Social Security, this is state income, state taxes, these are federal taxes, and these are all things that you're responsible for, and all these other things. And I'm like, yeah, you look at that a little bit different now, don't you?
Yeah, it adds up.
Yeah.
No, and just like you said, I mean, you mentioned it with your son and sitting down with an accountant or CPA. I think that's just it. As a business owner gets to this, that's where, talking with the right financial professional, accountant, CPA, hey, those are the resources to reach out to when you have those specific questions on your specific situation on what makes the most sense.
And I'm not the retirement guru here. I know, Jacob, you know more about retirement than I do. But like when it comes to that consideration of W-2 versus K-1, W-2, if you take more W-2, it does have an impact on your retirement benefits, like Social Security. If you're not taking W-2, you don't get Social Security benefits. You need to take some kind of W-2. And I believe it also impacts your contribution limits. Correct me if I'm wrong, because that's based on your earned income.
For Social Security?
For IRAs, 401ks, 403bs. Don't penalize me.
Or
on
like
that.
defined benefit plans.
Yeah,
I mean,
yeah.
so that's probably a conversation for another
That's
day.
definitely a little bit in the weeds.
I feel like that's like a trap to get Jacob to throw something in there. So not gonna buy. We'll just say conversation for another day.
Well, I heard the description today. That's a parking lot. That's a parking lot item that will come back to it.
Put a pin in it for another.
Yeah, exactly. So okay, so let's keep moving along. We don't want to make this episode too long. Okay, so let's zoom out a little bit, and let's talk about let's go back to taxes and sort of the discussion about entities and when the business owner is thinking about taxes. So do you find that today's income tax decisions are creating, frankly, I don't call it problems, but unanticipated issues like capital gains and things like that in the future? Like, what do you just, I guess, speak to the audience about those decisions and how important those decisions are that are kind of, am I an S corp? Am I a C corp? Am I an LLC? And those are kind of done almost, not flippant isn't the right word, but certainly done without as much thought about what this is, what this may look like 10, 15 years from now.
I definitely say, as you mentioned earlier on in the episode, when you choose an entity that you want to be as a business, it mainly is a tax decision. It'll impact all your tax implications moving forward. So for example, if you want to be a C Corp, well, now you have that double layer of taxation. You're taxed at the entity level, and then you're taxed again when it's distributed. Even though that corporate tax rate's relatively low at 21%, that double tax layer could actually end up making you pay more. Versus an S Corp or a pass-through where, yes, you're getting taxed at those higher ordinary rates, which are just your individual rates, but you also get the flow through of all the expenses and the deductions. So it might end up having a lower effective tax overall. But your entity decision impacts more than just income taxes. Like you mentioned, capital gains. A lot of people don't realize this, but there's a fun section called 1202, which is a qualified small business stock. I hate you both. So 1202, essentially what it allows you to do is if you're a C Corp and you are participating in a specific trade or business, then you can exclude up to $15 million or 10 times your aggregate basis in capital gains tax, which means when you turn around and sell your business in the future, you could essentially sell it like tax-free, assuming that you meet all the qualifications under 1202.
Capital gains tax-free.
Capital gains tax-free. So it's really a decision that you have to make at the outright because, while yes, you can convert your company later on, it's not as effective under 1202, but there's all these tax considerations that come with choosing your entity type.
What do you say?
I'm going to keep it a lot more simple. I think it's part of it's a balancing act. It's because a lot of times when you're thinking of taxes, you're thinking, and like right now, hey, everyone's getting ready to file their taxes and their tax returns. It's what can I do now? What can I do to reduce my tax liability today in this particular tax year? But doing things in the short term might not be beneficial in the long term. So how do I balance things that could help reduce my taxes today versus what can reduce my taxes in the long term for long-term planning? So it's having those conversations. It's seeing the trade-offs between the two and not just focusing on the short term, but balancing it with the long term.
Again, these are ideas and questions that we deal with in our day-to-day, right? Like when we're talking to folks and we deal with these types of questions in our day-to-day, usually we get in on the back end of it, which the decision's already been made and it's 10, 15 years later, right? Do you have any educational advice or at least advice is the right word.
We don't give advice.
We don't give advice. But just any thoughts around, man, what other things should you be or might you want to think about when you're doing entity selection and you're thinking about and not thinking about taxes alone?
In the estate planning context, when you deal with S Corp specifically, there's a lot of, while it is a tax consideration, it is mainly tax, there are requirements that you have to maintain your S Corp status. You have to have a certain number of shareholders. Those shareholders can only be a certain amount of people. And if you fail to do that, you could lose your S Corp status. Mm-hmm. But also, when you deal with the estate tax context or the estate planning context, certain trusts can't be an owner of an S corporation or it could disqualify that status. So you need to actually keep that into consideration and what kind of business you own and what you end up doing with it in your estate tax plan.
How about you? Other considerations?
No, I mean, I think the main things that come to mind are what Keely Joe said. So no, nothing else that pressing that comes to mind here for today.
Well,
how about you? It seems like you got something that you're thinking that we would say that we haven't said yet that you're trying to.
Well, I'm a little disappointed. Now I got to wait until now they're going to have to wait till the second episode of the Business
You're trying to lead
us
to the water. So what?
Of course, it's not drinking.
What are you thinking of?
No, I'm just thinking, and this actually it really does lead into. Because we're going to cut this off here because it does lead into the next the next part of our conversation. Like I think about the number of conversations that we have about about sort of the people that make up the business, whether it's the business owner themselves, whether it's a key person or key employees, and how that decision, that primarily tax decision made years and years and years ago, impacts the ability to recruit, retain, or reward a key person or key persons or the business owner, or doing some other things that they may want outside of taxes being a consideration. So that's kind of what I was thinking about, and that actually perfectly sets up sort of where we're going to end up. Or where we're going for episode 2 of this business owner arc, and we're going to talk about the idea that the business structure alone doesn't create the value, and it's the people in the business that oftentimes, or most of the time, creates that value. So for episode 2, we're going to talk specifically about people valuation. We'll call it enterprise value, and all that is a fancy way of saying, what's the company worth, and what goes into making that worth. What goes into growing that worth. That'll be for episode 2. For today, I want to recap and just as we talk about that entity choice. When you're young and like you're my son's age, and you're young and you're energetic and you're going to take on the world, and you make this choice. And it's, in this case, it's, we talked about pass-throughs, and you make this choice. That choice doesn't, or probably shouldn't be just for, one, either simplicity or ease, and 2, probably shouldn't just be for taxes. Probably, those are considerations, but probably not the only considerations that one should be making if you're starting out, in business. Would you agree to that?
Yeah, I got to think about liability.
I like it. Yeah.
All right. So if I'm giving, sort of education, and I'm talking to a prospective business owner out there, when you make that choice, I'm going to be this entity. Yes, easy. LLCs are easy to do, right? But we want to make sure, or you should be thinking about what are the tax consequences? Where do I think I want to go with it? What does that actually look like? And then we're going to give you other reasons why making that choice early on, there should be other considerations. So yeah, that's what we got into for this episode. Where we're going to be for the next episode, and we'll have one episode after that. Anything else you guys want to leave with? Last one?
No,
I think nothing. No, I'm good.
All right, so let's go ahead and end that here. Take that. Hopefully, you take that away with you about entity choices and about it being more than just a tax decision. Looking forward to coming back to that subject matter, but also diving into how the key person and key person or persons affect enterprise value. That'll be for episode 2. Looking forward to having everyone, and make sure you hit like and subscribe. And of course, you can put your comments down below. If you have a listener question, make sure you put those down below as well. I'm Troy Branch with Future Focus, and look forward to talking to you again. Have a great day.